Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates, 10-year note yields, edging ever so slightly higher, but holding within the range. If you go back since December 22nd, we haven't seen 10-year yields trade below 240. We've kind of held that 240 to 250 range, and today we got about to 247-ish, and we kind of went out. It looked like the market was tired. The employment numbers that came out today were very mixed. Yeah, we got the non-farm and payroll. Head roll was a little weaker. The unemployment rate held at the 17-year lows, and everything in between was sort of status quo. So I'm not really seeing today's number as a real driver of prices. It just seemed the market was very tired, and we just stuck within the range. And while equities continued their rally, it did not have much of an effect on treasuries, still holding inside that previously mentioned range, 240 to 250. Implied volatility begins 2018 right where it left off in 2017, trending lower, and the market doesn't seem to have any fear price. There's no real bias priced into the market right now. It just seems like there's this slow and steady outlook for yields to creep higher as long as the Federal Reserve is going to continue to raise rates slowly. It doesn't seem like we're going to get a big push anytime soon, and I think that right now with volatility being so low, it suggests complacency. I know it's a word they don't like to talk about when you're talking about volatility, but it really is. Given what we know about the Fed, with Washington policymakers, with what's going on in North Korea, which possibilities in the Middle East, there's a lot of hot spots, a lot of things that could change very quickly. The market doesn't seem to be too concerned about any of that happening. And the biggest one of all, a reversal in equity prices, is not even anywhere close to being priced. So volatility very low, a bit concerning. And lastly, if we look at what's coming up, we've got a full week of data. We've got supply coming out next week. We've got inflation data. Likewise, we've got a full calendar of Fed speakers. And if you look at what the Treasury curve's been doing, we did see a very little uptick in 2s, 10s, but now we're back on those 17-year lows. So the curve itself is telling you not a huge amount of concern, but certainly a lot of uncertainty out there that isn't being priced in volatility. So with the inflation data coming out, perhaps we'll get some clarity there. And if we do see stronger inflation data, perhaps the curve will re-steepen. But where we are and where we need to be are two very, very, very far places. And I think the Fed is going to have to be very concerned with how flat the yield curve is getting. So heading into the weekend, Treasury is not showing a whole lot of bias right here, but next week we do have supply and inflation. This is Todd Colvin coming to you from the floor of the CME Group.